Hello, everyone, and welcome to Zonda's first mortgage market update for 2025. My name is Nicollette Chapman, and I am so pleased to be here today. I'll be joined by Ali Wolf, our incredibly talented chief economist. And later in the session, we will also be joined by Rob Cooper, who is going to talk to us a little bit about reverse mortgage for purchase. Now, before we begin, please do note that we talk fast and cover a lot of ground. So if you miss something, don't worry, we will follow up later with a link to the recording. Please feel free to submit your questions at any time, and time permitting, we'll answer them live. Now, who are we? We are Zonda, a housing data and consultancy firm. We track the entire building life cycle from raw land all the way to the closeout of new home communities. Our database tracks actively selling communities across the country, and we can tell you who the best selling builders are and where to find the best selling communities. Now, let me tell you, our advisory group is unparalleled. If you are looking for custom work tailored to your needs, there's no one better. As a thank you for attending today's webinar, we would like to invite you to receive a complimentary local market snapshot. Please scan the QR code displayed here or ask for more information as you are prompted throughout the webinar. This is a highly relevant report, and I would encourage everybody to take advantage of this opportunity. I'd also like to take a moment to invite our Zonda customers to our upcoming events. We offer a wide variety of in-person opportunities in order to be able to connect and network with decision makers in the builder community. Our Deal Makers events are fantastic. They are 4 hours of relevant content. What a wonderful way to be able to network and connect with other people in the builder community, as well as bring referral partners and really take advantage of time to be able to learn from one another. We also have some of our flagship events coming up in Accelerate, and of course, my favorite, Builder 100 in the fabulous Laguna Niguel at the Ritz-Carlton. This is selling out quickly, so if it's something that you're interested, please make sure to register right away. You can get more information at builder100.com. We also have our Future Place event, which is fantastic, in October at the Ritz-Carlton in Las Colinas. Now, if you aren't familiar with Zonda Mortgage Pro, let me tell you, this is my favorite product that we offer. Of course, I'm a little bit biased. This product will work to help lenders secure more builder business by helping them identify opportunities to work with builders who don't have a solid lender partnership. This will also help you to track market share down to the subdivision level. You'll be able to access recruiting data. It's a super powerful platform. Please request more information if you are interested in learning more. Now, today's event is sponsored by Longbridge Financial. Now, Longbridge Financial is a wonderful partner for those who are interested in getting a reverse mortgage. Over 1/3 of homes sold in 2023 were actually purchased by buyers 58 and older. So we'll learn a little bit more today about the power of a reverse mortgage and why it's important specifically for home builders who are building in age-restricted communities. Now, on today's agenda, we are going to kick the 30-minute session off with an incredibly packed economic and housing data update. There's certainly no shortage of information to be able to discuss. When Ali is finished, I'll jump in and discuss sales strategies in order to be relevant in today's market. Now, as promised, I'll also be joined by Rob Cooper, who's a market leader for Longbridge Financial, where we will learn a little bit more and demystify the entire process of reverse for purchase. And so please allow me to introduce you to our housing guru and my friend, our chief economist, Ali Wolf. Now, for those of you who haven't heard Ali speak before, you are in for a real treat. She has been featured on various platforms across the country, including Bloomberg TV, Yahoo Finance. She consults the White House on housing affordability. She is a jack of all trades, I guess you would say. She is a well-respected thought leader, has her bachelor's degree in economics from the Ohio State University, and a master's degree from the London School of Economics. Now, one thing you may not know about Ali is that she actually is a very good guitar player. She's like a little bit of a heavy metal enthusiast. So go figure, maybe we should rename you the jamming chief economist. But with that, I will turn it over to you, Allie.
Nicollette, that's absolutely not sticking, but I appreciate the call out. If you guys know metal music, you know that for a intermediate guitar player, I'm not there yet. Right now, learning Sweet Home Alabama, so that's kind of where I'm at. So, hello everyone. I am delighted to be here to go through the state of the housing market. Now, I have about 15 minutes to get a lot in to discuss what we're seeing on the ground. And where I wanted to start today's presentation is with the idea of sentiment. If you think about how people feel about the housing market, in particular business professionals, us involved on the back end, sentiment will very much depend on whether we're focused on the new home market or the resale market. I don't need to tell anyone on the call about how existing home sales have just been bumping along the bottom, the lowest level we've seen since 1995. But the big shift, and really the tale of two different housing markets that we're seeing, is that new home sales finished last year up on a year-over-year basis and up compared to 2019. Now, these are two completely different paths and two completely different backdrops, which really begs the question, why is the new home market more resilient today? And there's a lot of reasons behind this. Part of it just comes down to what has happened with home prices and what has happened with housing stock. So right now, if you look across the country, we have the oldest housing stock on record. And for consumers that are looking to place money today to buy a home, they're having a hard time justifying the top dollars for an old home. It's a little bit easier to justify buying something brand new. We know in areas where insurance costs is important, people are tracking out, okay, what would my all-in housing cost be? There's substantially lower homeowners insurance costs generally for the new home versus existing. Incentives are a huge part of the reason the new home market is doing better, and I'll spend some time in today's presentation talking about those. But there's another factor, which is a narrowing of the price spread between new and existing homes. Historically, if someone wanted to buy a new home, they'd have to be ready to shell out an additional 20, 30, 40% because there was a premium of new. Today, new homes are only 4% more expensive. And yes, this is partly in response to home sizes trending down, builders building in different locations, higher density communities. But either way, if someone is starting to weigh their options, we know that this has favored the new home space. Now, this doesn't mean affordability is okay. We know that the backdrop, really across the country, regardless of product, is that affordability is strained for a lot of buyers, in particular buyers that are buying off of income versus wealth, which is why the incentive part of the new home market is so critical to understand. When you look at incentives, I think this is close to the sole reason why new homes have done better than existing, because builders will shell out that money to help entice consumers. Now, builders can offer incentives on two different product types. They can offer an incentive on to-be-built homes. These will be homes where a consumer can come in, they can pick their lot, they can pick their finishes. Builders can also offer incentives on quick move-ins. Quick move-in would be a home that they can move into within 90 days. You can see the distribution nationally. So incentives, 75% of all projects have an incentive on a quick move-in supply. That's because quick move-in becomes expensive for builders to hold. They don't want to have standing inventory sitting around for too long. Now, you aren't finding that quick move-in supply is building up in California or the Pacific Northwest or the Northeast. You still have very tight quick move-in supply. But in our high production markets, if you look at places like Florida or Arizona, parts of Texas, Colorado, this is where you're seeing more supply. And as a result, you're seeing more incentive usage. So in Florida, over 95% of all projects today are offering some kind of incentive. Now, incentives can be offered on different product types, but they can also come in different forms. They could be funds towards closing costs. They could be flex dollars, or they could be mortgage rate buydowns. Mortgage rate buydowns become really important in a market where someone is sitting on a 3% interest rate. To reset 3% to high sixes or 7 when you get to market rate, that's hard. That math breaks. But if a builder, and many are, willing and able to offer a mortgage rate buydown in the high fours to high fives, now you're asking a consumer to reset an interest rate from 3% to high four, at least the math makes a little bit more sense. So we know that these incentives are important because they play into affordability, but we also know they play into appeal. So not everyone is going to be buying a home with a mortgage, or maybe they're going to do a large down payment. So instead, maybe they want a design side incentive. This then again goes back to, why would someone buy a new home? Well, if the builder is going to give you money to build your dream kitchen or to deck out your property, that also helps some people justify the purchase. If you think about incentives as a percent of the overall average price, we find that right now we have about 4%. Incentives are 4% of the average price, and they have been trending up since we've seen mortgage interest rates trend up. If you're in some markets, this 4% is going to vastly underrepresent the market, partly because sales agents often have pocket incentives. So they will have their publicly advertised incentives, but then they will also have funds that if you come in and you're shopping for a home, or a buyer shopping for a home, they can say, okay, I have a little bit extra wiggle room that I can give you to help sweeten the deal. So given this backdrop of new and existing performing differently and the new home market having this special tool to drive activity, we then want to say, what has this meant for the start of 2025? What have we seen so far with January sales and really the beginning of the spring selling season? We have two ways to answer this. One is to look at our builder survey. One is to look at our data. So let's start with the builder survey. In January, we asked builders how the market was doing relative to their expectations. The highest share, 40% of builders, said demand was on track with what they expected. The next highest response, 33%, said, hey, demand is slower, but it's not worrisome. To me, that's the kind of response you would imagine in January. There's seasonality. You don't expect it to be great, but you're not seeing too many builders, at least on a national level, that are overly worried about the market. It does very much depend on area, on price point, on builder, on how much competition is out there, though. Because we hear from some builders that there's better than expected qualified traffic. Others say that sales leads are down 20% compared to the prior year. And I think a sentiment that a lot of people on this call can relate to is the market is choppy, the market is stubborn, but it's also steady at the same time. If I were to describe the national housing market to start 2025, I would use the word fine. It's not great. It's not bad. You're not hearing too many stories on one way or the other. It looks pretty similar to how we started last year. But the big difference this year versus prior years is that there are so many locational differences. So now we're taking the same question and we're looking at how do the responses look in Texas and Florida, our two largest production markets in the country. Well, you can see in Texas, compared to the national figures, you have more builders that are saying demand is slower than expected. Now, it's 45% say it's not worrisome, which to me is, yes, part of it comes down to what has happened with supply. Part of it comes down to seasonality. Florida is a state that we're watching closer, though, because you do have almost 40% of our respondents that are saying, hey, demand is slower and it's actually causing concern. And this is partly because we saw such a rapid run up in prices in Florida. We are seeing more supply. There's higher homeownership insurance costs. And so that's just causing a little bit of a shakeup in the local market. Now, like I said, Texas and Florida are two top production markets. I want to provide some early insights into 2025 and other top markets, though. We can do this with our weekly sales and traffic report. Now, we only have this for about, I think, 11 markets, but in 11 markets on a week-by-week basis, we can track what is happening with sales. So if you look at Southern California here, well, let's start by looking at traffic. How many people are coming into new home communities in Southern California? The answer is not many. The lowest level that we've seen over the past 5 years. That's what the light blue line is capturing. But traffic is only part of the discussion. You then want to say, well, what is happening with sales? People coming into the community and signing a contract. Now you're finding that sales activity looks much more normal. 2 years where we've seen higher levels, 2 years where we've seen lower levels. It's a pretty normal point with sales activity to start 2025. In fact, if you layer those two components together, sales and traffic, you can get a conversion rate. So of those people that show up in the community, how many people buy? And if you look at this, you actually find that the conversion rate in Southern California is the highest level it's been in 5 years. So you're finding that people that are showing up into the market are saying, I know interest rates are high. I know home prices are high. I know the market is tricky, but I'm motivated. I want to purchase a home for one reason or another. Let's take a look at Denver. You can see Denver for traffic, that light blue is 2025, low levels of traffic, not many people showing up into the communities. When you look at contract sales, low level of sales as well. So this is a market that looks different than Southern California, where you're not seeing those green shoots. You're not seeing some of those positive signs within the data. What about DC? Now, DC is going through a lot of changes. There have been obviously a new administration, but besides that, there's been some funding cuts, there's been some job cuts, new people moving in, new people moving out, just a lot of shifts. Well, if you look at suburban Maryland and Northern Virginia, I'd say I have surprisingly written there, I'd say shockingly good start to the year, given the turmoil, given the shifts. We did just release a report to our clients about things to watch in the DC market as we go over the next few months. But at least as it stands, we're seeing reasonable level of contract sales, in particular when you compare it to where we were the past couple of years. Let's finish this view by looking at Phoenix. So Phoenix is our third largest production market in the country. When you look at contract sales, good. I'd say, not as strong as where we were to start last year, but notably above 2023. Conversion levels coming in the highest of the past 3 years. Now, this, of course, in Phoenix does come down to discounts and incentives. We're calling the Phoenix market one where there's high demand, but also high supply. But really, our track and our goal is to say, if incentives are offered, are they effective? And generally speaking, you could say yes when you look at Phoenix as a whole. So we understand at this point that what is happening in the housing market will depend on if we're looking at new versus existing sales, and it will depend on market. But I also want to spend a few moments to talk about the type of buyers that are out there, because we saw a pretty notable shift in the buyer group in 2024 that we anticipate will carry on throughout 2025. Now, this data comes from the National Association of Realtors, and there were some fascinating trends, starting with just the most active group. So from 2014 up until last year, millennials were the #1 most active buyer. Only one point in time did baby boomers overtake millennials. In 2024, we see a near three-way tie, where now millennials are as active as baby boomers, who are as active as Gen Xers. This is a big mix-up compared to just a couple of years ago. Of course, some of the millennials will be first-time buyers, some of them will be move-up. Baby boomers, generally speaking, will be moved down. Gen X, you can find some of them that are move-up, some that will be first-time, but generally more towards that move-up market. Because we've seen this shift in buyers, this three-way tie, we've also seen the median age of the buyer go up. We're now looking at a median age of 56 for overall buyers. First-time buyers coming in just about 40 years old. That is the highest level that the NAR has ever tracked. No surprise that the #1 most active buyer will be married couples, median age coming in at 56. The second most active buyer group, though, single ladies. Single ladies have doubled in share over the past 10 years. And I could be biased because I'm a millennial, and I know that my millennial single friends are buying homes on their own. But actually, if you look at the data, the median age of a single lady buyer is 60. So this tells me that they probably have some wealth. They probably have some experience in buying a home in the past. Maybe they're buying because they're retiring, maybe they're divorced, maybe widowed. There's just different reasons why single ladies are so active in the market today. Another huge shift, which I wouldn't necessarily say is a permanent shift, but I do think it's a shift that will follow us throughout 2025, is the fact that back in 1985, 60% of home buyers had a child under 18. Today, we're only looking at 27%. To me, this captures that demographic distribution. You probably have the millennials that have children. Some of the Gen Xers, maybe they're now empty nesters. And baby boomers, we know that they're also empty nesters, and that's playing into the shift. If you ask yourself, why would someone buy now? One reason is pretty obvious. It's just the right time. I didn't have much of a choice. I'm getting married. I'm getting divorced. I'm having a child. I'm retiring, different life stage changes. The third reason, though, is better availability of homes. We're not flush with housing supply really by any means, in particular nationally, but we have seen in most areas across the country, there's more supply available than we've seen over the past 5 years. That's leading to a little bit more mobility, or at least a little bit more interest. So those are the people that we've actually seen buy, and I think that that distribution will hold through this year. But I also just want to spend a moment on those that are renting today. So if you have someone that's renting that says they want to own a home eventually, they are running into this backdrop of they have a lot of rental supply available to them, in particular if they're in the Sun Belt. We saw the highest level of rental completions hit the market in 2024 since we saw in the 1970s. 2025 is expected to be high as well. The reason this matters is when you have more rental supply available, oftentimes it will correspond with rent drops and or concessions, where a consumer can shop around, they can find 1 month free or maybe 6 weeks free. And so they'll be less eager to convert from renting to owning. Now, overwhelmingly, our data does still show that people want to own a home if they're able to. And in our recent millennial survey, we asked millennials, are you willing to put more money towards a mortgage than your current rent? Overwhelmingly, the answer is yes, but do notice that I said willing versus able. Obviously, the able is the part of the discussion that has been challenged. But to me, when you at least have the willingness to, 20% of renters said that they'll put up to $500 more a month towards owning a home. To me, that captures that they understand the value of homeownership. That as you're paying down your mortgage, and in theory, or with all hope, you're also seeing the value of your asset go up. That's really important for your net worth. Now, I study this data all the time, and I would say I had covered this stat and then I had forgotten about it, and I pulled it recently, and it's really astounding that the homeowner net worth is almost 40 times greater than those that rent. This doesn't mean everyone should buy a home. It doesn't mean people should buy a home today, in particular if they're stretching their budget. But if you have someone that's just kind of weighing the pros and cons, and yes, maybe owning a home is more expensive, but you're also investing in your future, to me, this stat is really one that stands out as why homeownership matters. Now, for millennials, we asked them again in our survey, when do you expect to buy? We have only 5% that say they never want to buy. The highest share say they want to buy over the next 1 to 3 years. But as time has gone on, you can see we've trended this out since 2020. We have more and more millennials that are saying, yeah, I want to buy, but maybe it's going to be 3 to 5 years from now. Maybe it's going to be over 5 years from now. And I think what we've seen is a shift in the market where supply was the limiting factor for the past few years. And now we've tilted into this environment where affordability is really the limiting factor, in particular for those that have not already purchased their home. In fact, when we talk to builders about how they're thinking about consumers today, it should be no surprise that the number one concern they have is that affordability is holding consumers back. We also see consumers are still on the sidelines, or consumer confidence is holding consumers back. We gave builders the option to say, hey, things are looking great for the spring selling season. We had fewer than 5% of builders say that. I think that's because there is more competition, because interest rates are holding high, because home prices are holding high. In general, as we think about this year, like I said, we're calling the market fine. We're really looking at as more of the same. As we think about the top things to watch for 2025, I had mentioned watching Texas, Florida, Arizona closely. What kind of challenges emerge? How does that play into sales activity? What are we seeing with supply and demand dynamics? The new administration, there's a lot of things to get excited about. Pro growth, we love it. Less regulation, removing red tape, good. But there are some policies that will disproportionately negatively impact our industry. Tariffs could result in higher construction costs for remodeling or new build. If we see mass deportations, that could play into the labor force. And the idea of higher for longer interest rates, of course, is not going to help with the affordability challenges. We know that there have been a lot of cuts, funding cuts, job cuts to the FHA, to HUD. We're tracking out what that could mean to the market. Yes, removing Fannie Mae and Freddie Mac from conservatorship could be good, but we also need to be careful of how quickly does it happen, how organized is it. If it ends up getting done a bit too quickly or it's a bit of chaos, that could impact mortgage demand, that could put upward pressure on mortgage interest rates. But ultimately, as we look at the market, a lot of reasons that we feel good about pent-up demand and demographics and different kind of consumers that are active. But affordability for us is the one factor that you really can't talk about housing without saying that that's going to limit growth as we think about 2025. Now, with that, I'd like to introduce or reintroduce Nicollette Chapman, our Senior Vice President for Mortgage. Now, Nicollette has over 20 years of experience in the mortgage space, including 5 here at Zonda. If you don't know Nicollette, I'd say you are missing out. She is kind, she is hardworking, she is competitive, and really just a fun person to be around. Nick has a milestone birthday coming up. I'm not going to say what, in June. She's welcome too, but she's actively right now planning a trip for south of France to celebrate. So Nick, I will just assume that my invitation got lost in the mail, and let me turn it to you.
Well, thank you, Allie. And she was kind enough not to mention the actual milestone of my birthday, but I am not ashamed to say I am going to be 50 in June. I said that is terrifying, but it's not nearly as terrifying as the fact that I have a going to be 25-year-old in March. So but either way, time to celebrate in France for sure. So thank you, Allie. Great information as always. We are scheduled to just run a little bit over, so I do apologize in advance if you have to drop. We completely understand. Know that that recording will be coming out to you, but if you're able to stay on, please do. We have some great things to sort of go over. Now, in terms of our mortgage toolbox, there's some things that you want to be able to discuss with builders in order to leverage what's happening in the current marketplace in order to be relevant. Namely, you're going to really want to tap into what's happening with those buyer demographics in order to maximize your product offering. So number one, we talk a little bit about baby boomers and how they're still a big piece of the marketplace. Now, knowing baby boomers though, and they want to be able to move to either be in warmer weather or in retirement communities, we also know that 43%, according to a recent Redfin report, say that they have no intention of ever selling their house. And a lot of that just has to do with either they feel they've paid cash for that house or their interest rate is really low. And so that's where this reverse for purchase for mortgage or reverse mortgage for purchase comes in. Fabulous product. If you have access to it, definitely leverage. And we'll talk to Rob Cooper a little bit about how to leverage reverse for purchase to those age restricted communities. Number two would be move up buyers. Absolutely a huge untapped area here. We know that people are tied into those low interest rates, but they also want to move. A lot of buyers feel like they got forced into buying a home during the frenzy that they don't really love, but they're stuck in it tied to that rate. So leverage HELOCs, leverage those close-end second mortgages in order to really allow this segment to rent out the house that they don't love, get some additional funds from rent profit, and then use that to subsidize the higher cost of the house that they really want. So absolutely tap into those programs. First-time home buyers is obviously a huge demographic. We know that people want to buy, they just can't necessarily afford to. So how can you be creative in order to provide solutions for affordability? Number one, familiarize yourself with HEI, those home equity investment programs. These home equity investors basically allow buyers to get the home they really want, maybe not a starter home, while keeping the mortgage low in exchange for a piece of equity in the house. LMI and MMCT tracks. If you are a bank and have community programs, make sure that you are targeting builders in those communities to help subsidize some of those zero down programs that are available. Absolutely, those are making a comeback. And of course, still in style, if you are offering forward commitments, if you are offering permanent rate buy downs, please have those conversations with builders, because a lot of people don't realize that that forward commitment money doesn't necessarily go towards your IPCs. So definitely important to be able to help move the needle more in terms of incentives. Now, I talked a little bit about reverse for purchase, and so I want to introduce Rob Cooper, who is with Longbridge Financial. He is an absolute expert on reverse for purchase, and I thought it would be good to have him on just to answer a few questions and sort of demystify, is this real? Is this a scam? What actually happens with reverse for purchase? And so, Rob, thank you so much for joining us today. I want to start off just by asking you, what is reverse mortgage purchase financing and how does it work?
Thank you, Nicolette. And that is a question that is misconstrued with real estate agents, with traditional loan officers. Pretty simple. I'll be very high level. What a reverse for purchase financing is, it's a mortgage, just like any mortgage. The bank does not own the title, is not on title. It's a mortgage, right? So the customer is on title. The biggest difference is how the customer pays that mortgage off. And what do I mean? The customer would bring roughly between, depending on age, anywhere between 45 to 65% of the sales price. There would be a reverse mortgage on what's left over. And then the big value proposition from the customer is they then do not have to make monthly mortgage payments. What would happen is the interest, it's a negative amortizing loan, so that the interest, if they don't make any payments, the interest will just accrue over time. And then they pay it off when, if someone passes away, the heirs are not responsible if it happens to go upside down, meaning the amount owed is more than the value of the home. The heirs or the estate are not personally responsible. What would happen there is the heirs would literally just hand the keys over to the lender. Longbridge, we service the loans as well, and they would walk away, be a deed in lieu. So that's high level what it is, and there's a lot of tactical uses for it from a real estate agent's perspective, from a traditional mortgage loan officer's perspective, with the people that aren't qualifying due to debt to income, with those that are having trouble to get a loan because they're on a fixed income. It's
Sure. And
it's much easier to qualify.
thank you for the high level overview there. Curious if you could just give us some quick requirements in order to be able to obtain a reverse mortgage for purchase.
So there's two different kinds right now. One, and the most popular, is FHA's home equity conversion mortgage. At least one of the applicants needs to be 62. Okay. Then there are private reverse mortgages that are almost identical in regards to the availability, in regards to what the in states. And the reason I am stumbling a little bit is because there are certain states, because with the private, we have to get approval from each state. Okay.
Got it.
Some states are a little bit more difficult than others, but in most of the states, it's an age of 55. So you're able to come down a little bit lower. And with Longbridge's platinum product this year, really good. It used to be more for jumbo customers. We've come down to a sales price of 450,000. So now you've really opened it up for the 55 plus buyer as well.
Excellent. And why would you say that customers are interested in this type of financing option?
Two reasons are the biggest reasons. Number one, as I mentioned, there is no required monthly mortgage payment, so that's going to help with their cash flow, especially in the environment that we're in right now. And number two is they're able to make a big challenge is finances, right? They're worried about outliving their money. Many of the people are on fixed incomes now if they've retired, and or they're getting ready, they're pre-retired, right? Or getting ready to retire. That's a concern. So being able to come to the table with, like I said earlier, between 45 and 65, depending on their age, the older they are, the more we can lend, the less they come to the table with. Being able to keep a significant amount of money, assets, typically from their departure home proceeds, is making a lot of them feel a lot more comfortable to make that buying decision. Those are the two biggest reasons.
Interesting. And we just got a chat question. What is the cost of a reverse mortgage?
So, good question. And this is sort of and I'm not going to say it's not expensive. If FHA, it is. The upfront, the reason that the cost is the same pretty much as a traditional mortgage, except with FHA, there is right now a 2% upfront mortgage insurance premium, and that's 2% of the sales price. That can be hefty, especially as the prices are elevated right now. And then there's a 0.5% annual. They're not going to see that, of course. That's going to be built into the interest rate. But that upfront cost with FHA, I wish it would come down. We're hoping that it'll come down. With the proprietary products that we talked about, you don't have that. The cost is the exact same as what a traditional mortgage cost would be.
Outstanding. Thank you. Timing. How long does it take to close with this type of product?
Very good question. We get it all the time. In the past, a lot of people didn't know what they were doing. Brokers, loan officers did not know, and it was taking 60 days. They just didn't know. Now I can tell you we're averaging 24.3 days from application. So I will say 30 days or less, just like a traditional mortgage typically.
Fantastic. And what about pre-approvals? Is that a similar process?
Yeah, same thing. We get it within right now, we're averaging a pre-approval back within 24 hours. It's not a DU or LP like you can do with a traditional mortgage. It's literally a manual conditional underwritten pre-approval. So it's the closest thing because we're getting a lot of information up front, making sure that the customer is legitimately able to get this program. We have to because it's a senior customer. So we have to really be careful that what we're telling them is accurate. So we literally go through and make sure that they are fully vetted. And when we give you that pre-approval, unless they take money between the time they go to contract from when we gave the pre-approval and spend it in Las Vegas somewhere, it's good. It's good. But that about 24 hours we say, but typically we get that back a lot sooner than that.
Perfect. Thank you. And then lastly, this is obviously a hot topic. Can sellers contribute to the buyer's cost?
Very good question. They could not up until October of 2023. So that really leveled the playing field for the purchase product with the reverse mortgages. Seller concessions can contribute up to 6%, just like they can, and that's both with the HECM loan, the FHA loan, as well as the proprietary loan. That has really made it a value add to the builder. And roughly just our purchase pipeline alone last year, about 37% of our fundings were new construction. And that's one of the reasons why. So we're seeing a significant increase in with new homes because of the seller concessions.
Those incentives making work,
That's
right?
right. That's right.
Absolutely. Well, thank you so much, Rob. If people
Thank you.
have questions or would like to get a hold of you, what is your contact information or email address?
Okay, so and I'm sorry, we should have given you that, but it's pretty simple. It's R Cooper, my email, at longbridge-financial.com.
Perfect.
And yeah, and if they wanted to contact me directly, they could, and that's 240-446-1300.
Perfect. Thank you so much.
Thank you, Nicolette. I appreciate it.
Appreciate it.
Thank
Um,
you.
and just to wrap up here, everyone, I do, as Ali said, I would like to leave you with some thoughts for consideration. Number one, buy now, pay later. It's something that we're talking about all across the industry. All of those things that you see on Instagram, where if you want to buy something that's $100 and you split it up into 25 payments, there's Affirm, there's Klarma, there's a bunch of different companies that offer this, but it is looming debt that's sitting out there. Usage just for Affirm is up 10% year over year, up to $18.2 billion, and hit a usage record over the holidays. A CFPB report said that the majority of these users have poor credit ratings. The reason this is something that we need to look into is underwriters are actually starting to count this debt towards DTI. That is problematic. It doesn't show up on a credit report, but it does show up on those bank statements. So we're working through this, but as I'm talking to different mortgage companies, some underwriters are actually counting that debt, some aren't. So definitely keep that on your radar. Also, FICO 10T and VantageScore 4.0 are coming out to replace that old tri-merge credit reporting system. Some lenders are already starting to use it, others aren't, but certainly that's something we're watching as well. As Ali also discussed, Bill Pulte, having been nominated as the FHFA director, overwhelmingly the builder community sees this as a positive. But one of his priorities is definitely helping to push out of that conservatorship. So keep an eye on that. And of course, we're hearing lots about Elon Musk and the CFPB. We can just leave it at that. Have some thoughts on it. Would love to hear what your thoughts are on some of these things for consideration. We do appreciate you attending our webinar today. Please do keep in mind that the survey will be out, as well as the recording. If you have any questions, please do reach out. Again, my name is Nicollette Chapman. I was joined today by Ali Wolf, our chief economist, and Rob Cooper with Longbridge Financial. We appreciate you and thank you for allowing us to run a little bit over today. Have a great day, everyone.